When you turn on the faucet in your kitchen to get a glass of water, you don't usually stop and think about like the miles of underground pipes or the filtration plants or the pressure valves that make it all happen.
Right, you just expect the water to flow.
Exactly. You just
Yeah.
expect the water to be there. And the global financial and healthcare systems, they operate the exact same way. There is this hidden, massively complex plumbing moving trillions of dollars around the world.
Yeah, every single day.
Right. So today we're doing a deep dive into the Q1 2026 earnings of the company that basically builds and maintains a huge chunk of those pipes. We are looking at SS&C Technologies to see how this legacy software giant is, well, secretly winning the AI race.
And what makes this analysis so critical right now is that SS&C just celebrated its 40th anniversary. I mean, we're talking about 4 decades of operating the back end of the global economy.
Which is wild because outside of Wall Street or highly specialized tech circles, they operate in almost total obscurity.
Totally. But whether you are, an investor looking at capital allocation trends or a technologist tracking enterprise AI or just someone inherently curious about how global infrastructure actually functions without collapsing, this is a phenomenal case study.
Yeah, it really is.
Understanding SS&C offers a masterclass in how to build incredibly sticky technology businesses that don't just survive market crashes, but actually use them to accelerate cash flow. And for our sources today, we are pulling directly from SS&C's official Q1 2026 earnings presentation and the accompanying press release, both dated April 23, 2026.
Okay, so to truly grasp the gravity of their influence, we have to start with the sheer scale of the money moving through their systems. Looking at just the first 3 months of 2026, the volume is honestly staggering.
Oh, it's massive.
They clear over $1.6 billion in just 90 days.
Yeah.
Both their GAAP revenue and their adjusted revenue hit an 8.8% growth rate. I mean, GAAP was 1,647.1 million, and adjusted was right there too at 1,648.2 million. But what's truly staggering to me isn't just the 1.6 billion. It's growing a base that massive at nearly 9%. It's like seeing a massive cruise ship suddenly accelerate like a speedboat.
That is a great analogy. It completely defies the traditional laws of business physics. Usually when a company reaches that size, growth typically flattens out into the low single digits.
Right.
But they aren't just piling on empty revenue. They're highly efficient at turning those top-line dollars into actual distributable profit. I mean, their adjusted diluted earnings per share, or EPS, jumped a massive 14.2% to 169 for the quarter.
Wow.
Yeah. And when we look at their adjusted consolidated EBITDA, which strips out a lot of the accounting noise to show us pure operational profitability, that reached $651.0 million.
That's huge.
It is. It's a 10.0% increase.
Here's where it gets really interesting, though. They achieved that operational profit with a margin of 39.5%.
Which is incredible.
Right. Retaining nearly 40 cents of profit on every dollar that comes in the door is remarkable for a software company carrying the heavy infrastructure of physical data centers. But, okay, let's unpack this for a second.
Sure.
A company this old and this large reporting nearly 9% top-line growth always makes me a little skeptical.
Yeah, that's fair.
Because it's incredibly common for legacy tech giants to artificially inflate their growth metrics by taking their massive cash piles and just buying up smaller competitors. M&A can mask a dying core business. So is this actual organic momentum, or are they just bolting fresh revenue onto a stagnant balance sheet?
That is the exact metric institutional investors zero in on, and the Q1 data provides a pretty definitive answer. SS&C reported an adjusted organic revenue growth of 5.0%.
Okay, so 5% pure organic.
Yes, and to understand why that specific 5% figure is arguably the most important number in their earnings release, you have to look at the mechanics of what they actively removed from the calculation.
Right, because they operate globally.
Exactly. Because they operate a global infrastructure, they are heavily exposed to currency fluctuations. A strong dollar or a weak euro can completely distort how much money they actually made. In Q1, foreign exchange impacts essentially erased $22.4 million in value.
Oh, wow. So they stripped that out to show what the business would have done if currencies had stayed perfectly flat.
Precisely. Furthermore, they backed out the revenue generated from recent acquisitions, which accounted for another $34.9 million.
Got it. So they intentionally removed all the M&A noise.
They did. Even after isolating the core legacy engine of SS&C, it is still humming along and expanding by a solid 5.0%. It proves their underlying product suite isn't just relying on bot growth.
The existing market demand for their back-end systems is fundamentally expanding.
Exactly.
Well, if the core engine is growing naturally like that, it means they aren't just out there hunting for new logos. They are fiercely holding on to the clients they already have while upselling them.
That's exactly right.
Which makes me wonder how their different business units are actually performing. If we look at the breakdown, it's pretty clear the momentum isn't evenly distributed, right?
No, it rarely is in a conglomerate of this size. The undisputed star of the quarter was their Global Investor and Distribution Solutions division, or GIDs.
GIDs.
Okay, that segment handles the complex, high-volume processing for asset managers and wealth firms, and it grew 10.4% on a massive $1.60 billion revenue base.
That's a massive base to be growing at over 10%.
It really is. Then you have the GlobeOp division, which is the backbone for hedge fund and private markets administration. GlobeOp grew 6.7% on an even larger $1.77 billion base.
And the healthcare tech division.
That also saw steady expansion, up 3.7%.
Though it is worth noting the wealth and investment technologies segment essentially flatlined, dipping slightly by 0.4%.
True, a slight contraction there.
Yeah.
But zooming out, the vast majority of their operations are expanding.
Which brings us to the underlying force driving all of this, which is their customer retention. I am looking at their Q1 2026 revenue retention rate, and it sits at a staggering 96.7%.
Yeah, that number is wild.
I mean, in the SaaS world, anything over 90% is considered excellent. Pushing 97% is almost unheard of for legacy software.
What's fascinating here is the structural reality of what we call mission-critical infrastructure. This is not consumer software where you can just, cancel a subscription.
Right.
SS&C utilizes highly diversified fee models, blending fee-based, account-based, and transaction-based revenues. And they lock this all in with strict multi-year contracts.
Yeah.
But the contracts aren't what keep the clients from leaving.
They aren't.
No, it's the operational risk of migration.
Oh, I see. It's like realizing the foundation of your house is outdated, but knowing that to replace it, you'd have to lift the entire house into the air while you're still living inside it.
That is a perfect analogy. If you are a massive hedge fund relying on SS&C software to execute billion-dollar financial deals or to manage complex, highly regulated healthcare data, ripping out that back-end system is excruciating.
The switching costs must be insane.
They are. The switching costs in terms of sheer capital, employee retraining, and the existential risk of a trade failing during the migration are just too high. You don't tear out the foundation unless it is actively crumbling.
So that operational paralysis is exactly why they maintain a 96.7% retention rate. The friction to leave is intentionally immense.
Exactly.
But, with customers locked in that tightly, are they getting complacent? In tech, if your customers physically cannot leave, you usually stop trying, you get lazy.
Wow.
You just milk the maintenance fees and stop spending on R&D. So are they actually forced to keep innovating to justify those multi-year contracts, or are they just cashing checks while the industry moves toward AI without them?
Well, complacency is the ultimate killer of legacy tech.
Yeah.
But SS&C's Q1 strategic moves show they are aggressively attacking that exact vulnerability. They aren't treating AI as a buzzword to throw into a press release.
No.
Not at all. They are treating it as an existential requirement to maintain that system of record status. In fact, CEO Bill Stone pointed out that marking 40 years of delivering mission-critical processing systems gives them a massive structural advantage.
Because they already have all the historical data.
Precisely, because they already hold all the data. They are perfectly positioned to thoughtfully adopt and orchestrate AI across those workflows.
And we see the tangible proof of that with their product rollout. On April 28, 2026, they are officially launching Blue Prism WorkHQ.
Yes, and this is a huge deal.
Because this isn't just a basic generative chatbot, right? It's an AI orchestration platform, which is a totally different ballgame.
Completely different. Orchestration means the AI is acting like a manager. It is coordinating multiple back-end systems, making decisions, and settling trades or processing claims without human intervention.
And they are actively shifting toward modern delivery, too. I saw that SaaS offerings now represent 11% of their overall technology-enabled services revenue.
Right, but the delivery mechanism is where SS&C is drawing a massive line in the sand regarding enterprise AI.
What do you mean?
They are emphatically avoiding the public cloud for their most critical deployments. When they discuss rolling out these purpose-built applications and AI orchestration, they specifically highlight that it's delivered via their private cloud and owned data center infrastructure.
They are literally building walls around the data.
Exactly.
So running AI in a private cloud for finance is less like a smart robot butler and more like having a supercomputer locked inside a bank vault. I mean, the AI is incredibly powerful, but its brain strictly cannot connect to the outside internet.
That's a great way to visualize it.
Which makes me wonder, in an era where everyone is rushing to AWS, Google Cloud, and Azure for their massive compute power, why take on the astronomical cost of owning the physical server? I mean, does owning their own data centers actually give them a competitive edge in the AI race? Or is it just a stubborn refusal to migrate to the public cloud because of the highly regulated nature of financial data?
It is arguably their most potent competitive edge,
Wow.
and it is entirely dictated by the regulatory paranoia of their clients.
Paranoia.
Oh, absolutely. If you run a major hedge fund, your proprietary trading algorithms and historical data are your only true assets. The nightmare scenario keeping these executives awake at night is feeding their proprietary data into a public, multi-tenant AI model on AWS or Azure.
Right, and having the model inadvertently train on their data.
Yes, only to leak those insights to a competitor who asks the right prompt.
Oh, wow. Yeah, if the public AI gets too smart using your secret sauce, your competitive advantage vanishes overnight.
Exactly. So SS&C solves the enterprise trust problem by embedding AI directly into the workflow, but guaranteeing the data never leaves a privately owned, entirely walled-off infrastructure. They eliminate the fear of data contamination.
That makes total sense.
Furthermore, they emphasize their multi-layer cybersecurity is operated under strict SOC-controlled frameworks by subject matter experts. We are talking about CPAs, CFAs, and PhDs managing the infrastructure.
Which is a crucial distinction. Usually, you boast about having the best software engineers from MIT or Stanford running your cloud.
Yeah.
But having a certified public accountant or a chartered financial analyst overseeing the data center operations proves the AI requires domain-specific supervision. A brilliant software engineer might know how to optimize server load, but a CFA knows the strict, unforgiving regulatory requirements of settling a complex derivative trade.
Exactly. The AI needs adult supervision from people who understand the financial math, not just the code.
Right.
And that domain expertise is what allows them to charge premium fees, lock in those multi-year contracts, and generate staggering amounts of cash flow.
Okay, so what does this all mean? We have an infrastructure business hitting almost $1.65 billion in a quarter. They are growing organically because their pricing power is strong. Their customers are effectively locked in, and they are successfully defending their moat by deploying secure private cloud AI.
Right.
So, building on all of that, we have to turn to the ultimate scorecard, which is the capital allocation. In Q1, this machine generated $299.7 million in net cash from operating activities alone.
Which is up 10.1% from last year, by the way.
Wait, if they generated nearly $300 million in free cash in just 90 days, I would expect an aggressive M&A spree. I'd expect them to be buying up every small AI startup in sight to bolt onto their private cloud.
You would think so.
But looking at this allocation chart, they aren't doing that at all.
No, their capital allocation strategy for Q1 2026 tells a very different story about their internal priorities. Out of the capital they decided to allocate this quarter, a massive $233.3 million was returned directly to the people who own the company.
And the breakdown of how they returned it is wild.
It really is.
They repurchased 2.3 million of their own shares for $168.0 million, paying an average price of $72.60 per share. And on top of that, they paid out $65.3 million in common stock dividends.
Exactly.
If you look at the percentage breakdown, 98% of their allocated capital went strictly to shareholders through those buybacks and dividends.
98%.
That's nuts. And the remaining 2%, just a measly $5.7 million went to paying down debt.
Right. Which leaves them with a net leverage ratio of 2.76x. For a company carrying $7.46 billion in gross debt, choosing to allocate 98% of your excess capital to shareholders rather than aggressively paying down the principal is a massive strategic signal.
But is it a good signal? I mean, if they are handing 98% of their allocated capital right back to shareholders through buybacks and dividends, is that a sign they don't see any exciting companies worth acquiring right now?
Well,
Or is it just supreme confidence that their own stock is the best possible investment?
in the context of mature tech companies with highly predictable revenue, it is almost entirely a signal of supreme confidence. Let's connect this to the 96.7% retention rate we discussed earlier. SS&C knows precisely how much cash is going to flow through their doors next month, next quarter, and next year because the contracts are locked and the clients practically can't leave.
Right, that visibility is huge.
Exactly. That extreme visibility allows them to comfortably service a $7.46 billion debt load without panicking. It allows them to fully fund the internal development of major platforms like Blue Prism WorkHQ.
And even after covering all of those operational and strategic bases, the cash printer is still running hot enough that they can aggressively retire their own shares.
Right, which essentially artificially increases the value of the remaining shares for their investors.
And the forward guidance they issued completely backs up that confidence narrative. They aren't hoarding cash for a rainy day because they don't see a storm on the horizon.
Not at all.
They are projecting Q2 2026 adjusted revenue to come in between $1,640 and $1,680 million. And for the full year 2026, they are projecting adjusted revenue at $6,664 to $6,824 million. That is not the forecast of a legacy company bracing for disruption. That is a company fully expecting steady, compounding expansion.
They have built a financial fortress.
They really have. So bringing all these threads together, the picture of SS&C Technologies that emerges from this deep dive into their Q1 report is fascinating. They are not merely surviving the modern era. This 40-year-old financial plumbing giant is actively thriving.
Without a doubt.
They are hauling in over $1.6 billion a quarter and growing their core organic business at 5%. They are fiercely defending their territory by locking in clients with near 97% retention rates.
Because the friction to leave is just too severe.
Right. And rather than resting on their laurels, they are aggressively pushing AI orchestration into the market, but doing it inside hypersecure private clouds to protect the world's most sensitive financial and healthcare data.
Exactly.
And ultimately, they are leveraging this entire apparatus as a highly efficient cash printing machine, opting to reward their shareholders with massive buybacks.
It is the definition of an invisible monopoly. While SS&C might operate entirely behind the scenes, far removed from public consciousness, their back-end technology is deeply embedded in the daily fabric of the global economy.
For you listening right now, while you may have never heard of SS&C before today, their code is almost certainly touching your life. It is quietly processing your 401k rebalancing, it is managing the complex administration of the mutual funds in your portfolio, and it is handling the secure back-end routing of your healthcare data every single day.
They're the invisible pipes making sure the water flows.
Exactly.
And that leads to a final, slightly provocative reality to consider. We've mapped out how SS&C is integrating sophisticated AI orchestration platforms like Blue Prism WorkHQ deeper and deeper into this highly regulated, mission-critical infrastructure.
Right?
We are rapidly moving past the point where AI merely analyzes financial data to give a human a recommendation. The ultimate goal of orchestration is autonomy.
Yeah, that's the big shift.
Exactly.
Okay.
So we have to ask, as these legacy systems upgrade, are we heading toward a future where AI isn't just analyzing data, but autonomously running the very plumbing of the global economy?
Oh, wow.
And if an autonomous AI makes a mistake deep inside a system of record that processes trillions of dollars, who is ultimately held accountable?
That is a fascinating and frankly terrifying paradigm shift.
Well,
When the invisible plumbing starts thinking for itself, you really have to hope the pipes don't burst.